You switch to a business news channel every morning and you see the markets, they are only in one color, red. You look at your portfolio, you see only one color, red. Well, you are not alone. Millions of Indians are going to relate with you. But when will this stop? What should you do? Continue investing or stop? If you had this thought in your mind, you are watching the right video. Bloodbath. This is the right word for the market situation right now. But why? Why are the markets falling so much? Aggressive FPI selling is one of the reasons. US bond yields are rising, dollar is getting stronger. With Trump's return, a trade war is something everyone is anticipating. Tariffs were hiked on steel and aluminium. Markets are fearing retaliation cycle, and there is a lot of uncertainty about the tariffs in the US. Weak Q3 earnings was also one of the factors that India Inc. could not meet expectations in the third quarter. Despite the market correction, there are still worries that the market is overvalued. As of February 12, the ratio of India's total market cap to its GDP stood at 114.6%, which puts it in the modestly overvalued status. Experts say that the small caps and mid caps are considered particularly stretched in valuations, and the weak Q3 earnings have made it difficult for the markets to sustain these high valuations. So these were the reasons: FPI selling, strong dollar, trade war uncertainty, weak Q3 earnings, and valuation concerns. So now, will the markets fall more, or will they even ever rise? What should investors do is the question. From the last few days, markets have seen a decline every single day except for on February 17 when they broke the 8-day falling streak. JM Financial says that it is nothing to worry about because, as per historic analysis, after falling consecutively for so many days, markets usually rebound going up on 1 month or a 3-month basis. So when we see the AMFI data, looks like the sentiment among the retail investors is positive, because the decline in inflows in SIPs in particular was very low, and still it managed to make it more than 26,000 levels. Now you can also invest in SIPs with just 250 rupees right now just in the SBI Balanced Advantage Fund, but when it scales bigger, it will only increase the inflows is what the reports are suggesting. And Morgan Stanley also thinks that this is a buying opportunity, this correction. The brokerage says that it is confident in a recovery, says government spending is good, budget was pro-growth, RBI is taking liquidity measures, series of tax reforms will boost foreign investments is what it is saying. It also said that India should resume outperformance to emerging markets in the coming months. So it says that the factors for growth are the slow growth phase is coming to an end. Liquidity is high in the system, tax reforms will boost FDI, retail and domestic institutional investors are strongly supporting the markets, low correction with emerging market volatility, and risk of tariffs, particularly for India, is a minor concern post the Indo-US deal, and the impact is going to be very limited is what it says. It also said that the valuations have declined and are attractive for long-term investors, and the brokerage's proprietary sentiment indicator has entered the buy zone for the first time since 2022 mid, which suggests that the market downturn is nearing. For strong business growth, it says that India is seeing a reversal corporate deleveraging, leading to more private capex investments, which will drive earnings growth in the coming years. Additionally, in November 2024, Goldman Sachs had projected a 15% recovery for Indian markets in 2025, with the Nifty 50 likely to reach 27,000 points, rebounding from its current market volatility that has been happening since September 2024 due to FII outflows. Not only these brokerage reports, but more experts on ET Now have also said that long-term view is positive for the market, especially in the large caps. Listen in.
Whenever the pain is there, I think you will hear noises like don't buy any stock, don't buy mid cap, small cap at all. So, but one needs to see what they're holding and what potential the stock has, and not worry about the short term, and always think about the medium to long term as far as investing is concerned.
This kind of correction is I would consider as normal. A few factors which also maybe going for us. One is that locally liquidity is coming back into the system. We had very tight liquidity, and because of that, credit growth also was down. The dollar was very strong. DXY had touched as high as from 100 in September. It had almost 110 till recently, but that also seems to be correcting. We are closer to 106 now. So a lot of the technical factors, the currency factors, liquidity factors are kind of normalizing.
Large caps are relatively looking more stable at this point of time. The selling pressure over there, I think, has significantly reduced as I see it, compared to, I think, the vulnerable mid cap and small caps, I think, which is continuing to exhibit higher amount of pressure even at this point of time. But that is at the tail end of selling as I see it currently.
So markets are definitely in a bad position right now if you look at short-term investing. But if you want to buy it and leave it for some time for long-term, it might actually help you, is what the experts are saying. But you know what to do. Analyze, see what is your risk profile. If you are looking to invest in short-term or long-term, it is your money. So seek advice from a registered financial advisor before making a decision if you are not an expert yourself. For more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.